Just when you thought that inflation, banking crisis, interest rate hikes, and high mortgage rates are the only problems to be addressed right now in the U.S., there's more. Bank of America's Chief Investment Officer, Michael Harnett, has a history of predicting things right for BOA's high-wealth clients, and he has some new predictions for all of us to know. According to him, the next big bubble that's on the verge of bursting is the money market fund, or MMF assets. What the heck is it first? MMF is a type of investment or mutual fund required by the SEC rules that pool money from many investors and invests in short-term, low-risk securities like government bonds, certificates of deposit, and commercial paper. Money market funds aim to provide a relatively safe and liquid investment option that generates modest returns, similar to a savings account. They're commonly used by individuals, businesses, and institutions as a place to park excess cash or as a short-term investment option. Right now, what's happening is the money parked at money market fund assets is at a record high $5.2 trillion level. This means that the MMF market is surging, and history tells us that the last 2 times this happened, it coincided with the Fed cutting down the interest rates big time. Have a look at this data right here that explains the trends of federal funds rate versus the money market fund's assets. If you see closely, you'll notice how a surge in the MMF market is coupled with a Fed cut normally. This is exactly what we saw in the 2008 financial crisis and then again in 2020. Now, you should also know why that usually happens. In times of economic uncertainty, investors seek out safe havens for their money. MMFs are often viewed as a safer alternative to stocks and bonds because they invest in short-term, high-liquid securities with minimal credit risk. This makes them a popular choice for investors seeking stability in their portfolios. Coming back to the chart, you can see how both values are making peaks right now, and looking at the history, it should result in the Fed cutting rates down. But what if they don't do that? This is precisely what it looks like they're trying to do. The Fed has no sign of cutting down the interest rates, which sit on the never-before-seen 5% rate after the recent rate hike on March 22nd. And this hike is the 9th one since the Fed began raising rates a year ago. Now, this $5.2 trillion MMF market looks like it's ready to pop. And we're saying this because the risk associated with this comes from what happened after the 2008 scenario. After that financial crisis, people who had money sitting in banks and MMFs were left feeling uncertain about the safety of their investments. As news of bank failures and bailouts spread, investors began to fear that their money could be lost if their banks went under. The resulting panic led to people in large numbers pulling their money out of the banks, essentially giving birth to a bank run. Next, we saw a global financial meltdown, which ultimately resulted in the government having to set out protections in place and bail out banks and other financial institutions to prevent a total collapse of the financial system. But these protections aren't exactly for you and me and our hard-earned money. It's actually for the banks, which enable them to halt your cash withdrawals. MMFs do the exact same thing like the banks do with the money deposited in them. They effectively invested in fixed assets. So naturally, if they see liquidity issues rising as people start withdrawing cash from them simultaneously, they can run out of enough liquid to pay them out. Now, just remember the current happenings in the banking sector. It's starting to collapse, right? Some of the banks have already faced that fate. This means that there is a rising tension among people with cash assets sitting in the banks. Doesn't the scenario look similar to the 2008 crisis we discussed? Hey, if you're enjoying this video so far, you'll like the rest of it too. So do like and subscribe to our channel to stay up to date. Let's bring GAO, or the Government Accountability Office, into the picture now, which is an independent agency that provides auditing, evaluation, and investigative services for the U.S. Congress. Its role is to ensure that the federal government operates efficiently and effectively and to help improve government programs and policies. Now, the GAO conducted a study on the 2008 crisis and later the pandemic, when investors in money market funds cashed in their shares at the same time to avoid losses. When this happened after the 2008 crisis, the SEC revised its rules and imposed a redemption gate to temporarily block investors' access to shares if funds were low on cash. Later, during the pandemic, the same thing happened again, indicating that the SEC's revised rule of holding minimum levels of liquid assets and charging a liquidity fee for redeeming shares wasn't effective and did not prevent runs. The investors did, in fact, run to cash in shares to avoid a potential gate by preemptively redeeming MMF shares to avoid the fee and losing access to their money. This chart shows the significant 30% drop in the net assets of MMF during the pandemic in just 2 weeks during March 2020. So last year, the SEC proposed a new rule of removing fees and gates, increasing the minimum liquidity requirements, and adopting a new method of pricing MMFs. This new rule could help reduce the run risk, and they plan to finalize it this month in April 2023. If this new rule passes, there could be a new restriction in place that will inhibit the withdrawals of money in times of financial uncertainty. This is some perfect timing, isn't it? The banking sector is struggling, and now this new rule could be implemented in a few days. This should ring bells for people who have their money in MMF accounts. Now, how does this affect real estate and mortgages? The situation is worrisome for the housing sector because it could easily spread to the commercial real estate and residential home loans like the typical mortgage. To really comprehend the situation, you need to know the basics of how the lending market works. When you take out a mortgage to purchase a property, you essentially borrow money from a lender to finance the purchase. However, once the deal closes and you start making payments on your mortgage, the lender can choose to sell your loan to an investor. This allows the lender to free up cash that can be used to originate more mortgages and keep the lending market flowing. The availability of investors is crucial to the functioning of the mortgage lending market because it determines the market's liquidity. If there are many investors looking to invest in mortgage-backed securities, lenders have an easier time selling their loans to investors and can therefore offer more favorable terms to borrowers. On the other hand, with few investors, lenders may have difficulty selling their loans and even offer less favorable terms or hold on to the loans themselves. Unfortunately, there aren't enough investors currently willing to buy mortgages, and the Federal Reserve is no longer buying them either. This means that the only buyers are the big money managers who have traditionally invested heavily in mortgage-backed securities and are looking for diversified fixed assets. But at the end of the day, it's their money, and nothing guarantees its availability all the time, right? This is the reality right now. These money managers are no longer consistent in investing their money and instead are hoarding cash and sitting on the sidelines, waiting for the next interest rate hike to occur so that they can go on a buying spree. According to a report, investors moved $508 billion into cash from January to March this year, and this is the largest quarterly inflow since the pandemic. They're even calling it a dash for cash. This is all due to the collapse of the U.S. regional lenders, Silicon Valley Bank and Signature Bank. This situation can significantly impact the availability of credit for home buyers and the overall health of the real estate market. There is evidence that we are experiencing a tightening of lending, which is shown here. An increasing number of banks are simply lending less money to small firms as commercial and industrial loans. This tightening is only going to increase to 2008 levels and will equally impact the consumer lending loans like credit cards, auto loans, mortgages, and so on. And this data shows the same. This tightening of loans is increasing, and it will all come down to one thing. Lending will really fall down because the lender can only lend if he has money. This means securing a loan will be drastically difficult for an average American. So, to conclude, the housing market is going to crash, and a recession is imminent. We should all really brace for impact.